All right. Good morning, ladies and gentlemen. This is John Randall, Regional Director for Golden Care USA. We would like to welcome Mark Warnock today. He'll be going over our Washington National. First, I want to make sure I thank everybody for coming on board, taking time out of their day. I think you're really going to like this product if it's the first time you've seen it. Hopefully you saw the first part of it. If not, we do have it recorded. And we're planning on recording this one so you could watch both of them again to get more familiar with it. But I think it's going to fill a great need for us. So I really like the product. I really want to thank Mark for coming on. Mark's been in the industry here for 26 years with Washington National. He's director of the Sales South. He spends all of his time servicing agents and partners, and he's glad to answer questions. Which is really nice because we're going to need a little help to begin with. It probably isn't that difficult a product once you get into it, but on the top it can look like it can look really heavy, but I think Mark's going to tie that all together today. So I want to give a big shout out to Mark. Thanks for taking your time and working with us here. And with that, Mark, I will pass it over to you. Thanks again.
Well, thank you, John, and thank you, Team Golden Care. And this morning, as John mentioned, we're going to take a fairly deep dive into a unique policy that we call Active Care. And today, in this Active Care presentation, I'm going to cover 6 elements of the policy. First, why should clients buy the policy? What's in it for them? Second, why should you sell it? What's in it for you? What are the differentiators? Then we're going to talk about features and benefits. This is going to be largely the body of the presentation, but we're also going to discuss underwriting in detail. We're going to break down the underwriting questions so that you're going to know when to send in that application and when not to. Then we're going to round the corner with the last 2 benefits being discussing the position of the policy, how to position this policy in the marketplace. Where is it intended to fit? Where do most agents sell this policy? And then we'll wrap up with some sales tips. Lastly, I'm going to end the presentation with a sales incentive, a premium incentive for all of the attendees on the phone. Now, as I move through the material, John is going to have all of you muted to help kind of reduce the background noise. But please jot down any questions that you might have, because at the end of the presentation, John and I are going to open up the lines, and I will remain here with you to answer any and all questions that you have about Washington National or about the policy or about how the policy works, and I'll stay until all questions are addressed. Now, I'm also going to provide you contact information for myself as well as the team that has been assigned and dedicated to serve Golden Care agents. So I'll provide those at the end as well. As John mentioned, this on its outset is a fairly robust policy. It also has a tremendous amount of flexibility, and because of that, I will be brisk, but I'm going to be thorough, and as a result, probably please consider giving maybe an hour to an hour and a half for this presentation, questions included. So with that, let's go ahead and begin. And I'm going to typically begin with our portfolio because I think it helps build the structure of this policy. If you look at the left-hand side of your slide here, you're going to see that Washington National's portfolio includes a supplemental cancer policy, an accident policy, a heart attack stroke plan, a hospital indemnity plan, and a critical illness policy. And what's important to note about those policies are those are all standalone policies. But it's also important to note that if you took all of those policies and mushed them into one plan design, you have Active Care, and that is the policy that we're going to discuss today. So when I was first asked to create the plan design as well as the training design, rather, for this policy, really considered a bunch of different ways to position this policy. In other words, what is the elevator speech of this plan? And I actually have 3 of them here. The first one is that Active Care is a single source solution for the gaps in coverage that you're likely to find in any high deductible major medical market, Medicare Advantage, Medicare Supplement, health share plans, any place that you have a medical policy that has a deductible, a copay, or some sort of personal responsibility on the client end. This policy is designed to gap fill those policies. Now, a second way that I chose to kind of, or the second elevator speech that I have for this policy is over the years I've had agents ask me, hey, Mark, I like your cancer plan, I like your accident, I like your hospital indemnity plan, but I don't want to fill out 3 applications, and I don't want 3 different deductions, so what can you do for me? And in the past, I've not been able to do anything. I mean, we couldn't get underwriting and actuary to agree on how to put together the application and what are going to be the questions, so we had separate policies until Active Care. And now we can give them that option. The third way is look, if you simply took the best features of the most popular supplemental health plans on the marketplace today, and for the sake of our discussion, let's call that lump sum critical illness, cancer, accident, hospital indemnity, and indemnified accident plans, and you mush them together in one plan design with one universal application, you get the policy that we're talking about today. And this policy does have uniqueness. There are some critical illness policies out there that do cover heart attacks and strokes, but they don't necessarily combine hospital indemnity and accident and major organ transplant and comas, all of those into one major plan design. And that's the uniqueness of this policy that we're going to discuss today. So in aggregate, our Active Care policy covers 17 different types of critical illnesses, 14 different types of accidental injuries. We have lump sum benefits that go as low as $5,000 up to a high of $100,000 in lump sum benefits. This policy features simplified issue underwriting. So you ask health questions at point of sale, and based upon those health questions, you're going to know whether your client's application is going to get issued or not. And we'll actually go through those questions today. But please note, this policy is guaranteed renewable for life, which means that once your client has the policy issued, as long as they continue paying their premiums, they will have a guaranteed renewable policy. The policy does not reset at an older age. It does not increase premium with age. It does not decrease benefit with age or usage, nor does it decrease your compensation with age or usage of the policy, and I'll repeat that as we move through the plan. So not only does the policy, in terms of its structure, create some uniqueness in the marketplace, but it also features a cash value or return of benefit rider that can be attached to this policy, which creates an environment that is truly unique in the marketplace, and that is that you can create an environment where your client cannot lose. If they have this policy and they have a return of premium or cash value rider, the worst thing that can happen to them is they break even. And I don't know of another policy in the marketplace that can provide all of those solutions in one plan design. So let's discuss the first element of our policy today, and that is, why should your client, and I mean every one of your clients, friends, neighbors, coworkers, why should everyone own an Active Care policy? Well, friends, we've all seen these stats before. Half of all men and 1/3 of all women will be diagnosed with cancer at some point in their lifetime. Given those statistically, that means 112 million Americans are going to be diagnosed with cancer in their lifetime. Now, that's probably too big a number for actually all of us to really digest. So let's break this down. Let's take a look at the number of people that are going to be diagnosed with cancer just this year. Now let's break it down even further. Let's go 55 and under. 685,000 people will be diagnosed with cancer 55 and under just this year. And if you include those that are over the age of 65, that number leaps to 1.685 million people diagnosed with cancer in a singular year. We're talking about a pandemic now. It doesn't hold a candle to what we're talking about with cancer. And here's the important part, the sub-bullet point right there. According to the American Cancer Society, of the trillions of dollars that are spent every year to treat cancer, 61% of those are not covered by major medical, Medicare Advantage, Medicare Supplement, or health share policies. These are the personal responsibilities. These are the out-of-pocket costs that are associated with the policy. And it's not just the direct costs, like the deductibles and copays. It's the associated costs that come with that. It is the travel. It's the hospital or the hotel stays. It's child care. It's adult care. It's special dietary needs. It's travel to and from the hospital. It's parking. All of these expenses come out of your client's policy, and because these policies are designed to put money directly back into your client's pocketbook, that's how these policies help clients in all of these situations. In addition to cancer, we also have noted that 86 million people have currently today have one or more types of cardiovascular disease. And some of them may even have heart attacks or strokes. 50% of those people will survive. There are more than 5 million stroke victims alive today. And one thing that all of these people have in common is persistent, possibly catastrophic out-of-pocket medical costs that are eating away at their savings or potentially putting at risk their ability to keep their home. These policies are designed to help those folks. In addition, 40 million people are going to receive medical attention for an injury just this year. And what I mean by that is that they're not going to have an injury that prevents them from working for the rest of their life. It's just going to be an injury which has some work restrictions or some sort of movement restrictions. 40 million people are going to receive that kind of medical attention, and 82% of those costs are out of their pocket, not covered by major medical, Medicare Advantage or Medicare Supplement or health share policies, even greater than that of cancer. Why? Because if I break an arm and it's early in the plan year, I might be paying that broken arm, all of the costs for that broken arm out of my pocket until my deductible is reached. That's why it's even higher than cancer. If I have a cancer diagnosis, I'm hitting my deductible right away. In addition, the hospitalization is also covered under this policy. The average hospital stay is over $1,100 out of pocket, and the average days stayed is 5 days across the country. Therefore, it's no real surprise that 45% of all healthcare costs are tied to hospital stays. And I mentioned before, the reason that I mentioned all of these stats, facts, and figures is because all of these benefits or all of these stats can be addressed by the benefits within our policy. These are the reasons that your clients need this policy. But don't just go by the stats. When you're visiting with your client, ask them, have you been touched? You, family member, friend, been touched by cancer, heart attack, or strokes, or some sort of critical illness? Have you had a debilitating accident or a hospital stay? And if so, that experience, how much did it cost you? Now let's go into the second element, and let's talk about why you should sell this active care policy. Of all the policies in our portfolio, of which there are 14, this is the most robust plan. This policy has 75 indemnity and lump sum benefits built into a single plan design. It also has the widest age band available of any of our plan designs, with an issue age of 18 to 85. Now, please note, there are going to be some state restrictions on this. For example, Florida, the issue age is 18 to 74. So make sure that you're looking at your state, and certainly we'll give you guidance on the issue age limits if there are any. But across the board, 18 to 85 is an issue age, as I mentioned before, and I will mention again. This policy is guaranteed renewable for life. Benefits will not decrease with age or usage of the client, nor will your compensation decrease with the age or usage of the client. Now, this is also a modularized plan design, which means that it is sold in modules. You can buy the plan as it stands, all 75 benefits, or you can pick and choose the modules that either fit the client in terms of what concerns them, what benefits do they want, or the price point that they need to hit. So we can build flexibility into this plan design. As I mentioned, this is a simplified issue policy, so you're going to know at point of sale, hey, this policy is going to get issued. No, it won't. And I know, therefore, if I'm following those rules, you're going to get paid on every single application that you submit to Washington National. So therefore, your cost and your investment in your business will be returned as long as you follow the very simple underwriting rules. Now, the other advantage to this policy is that we only look back 5 years for major health conditions. No MIBs, no PHIs, no medical tests, no family history questions. Once again, you're going to know at point of sale or even in a pre-sale environment whether this policy is going to get issued or not. Once again, a better return on your revenue investment. Now, I'm going to talk a moment here in this next important bullet point, a little bit of Supplemental Health 101. Within this policy, we can blend, or we have blended, lump sum benefits and indemnity benefits in one plan design. Now, why is that critical? And allow me just to step on the soapbox here for just a moment to describe why this is a critical piece and a big differentiator in this policy. What I was raised, and John was too, in the kind of old school, old style indemnity supplemental health benefit plans, the cancer policies, the accident policies that have a schedule of benefit. The advantage to those policies is that they're available to the client for their entire lifetime. There are no maximum benefits. And there's no other limitations. There's no age limitations. They have the policy as long as they need to use it. The problem with those policies is because there's a schedule of benefits, you don't really know which ones that you're going to pick from to highlight, here's how the policy works, here's how a benefit's triggered, to know whether those benefits are going to excite the client enough to actually purchase the policy. So there's some learning that needs to go through with some of those policies. Now, the other side, let's call it the newer school of supplemental health, these policies are lump sum policies. And the benefit to these policies is they're very easy to determine how the policy works. John, God forbid, if you're diagnosed with an internal cancer, heart attack, stroke, or critical illness, you're going to receive this pot of money. So they know how the benefits are triggered. Those are very easy plans to sell because in order for a client to buy a policy, two things need to happen. They need to know, does the plan fit their needs? Do they need this policy? And number two, do they understand how the benefits are triggered? Typically, lump sum policies are very easy to transfer that information. The problem with lump sum policies is they're typically one and done policies, meaning once the client has their benefit, typically the policy is terminated. Now, when you blend indemnity benefits and lump sum benefits into one plan design, you have the advantage of that simple, easy presentation on how a benefit is triggered and the need for the client. But you also have the lifetime usability that is built into indemnified benefits. And that policy, those are captured in this policy. You can sell it with a fairly simple presentation, and it has lifetime usability. In fact, we built an even greater lifetime usability by building in recurrence benefits and the ability for every covered member of the family to receive their full benefit. So even if a primary family member has exhausted their lump sum benefits, they still have access to their indemnified benefits, and the rest of the family have access to all of the benefits. And I'll repeat that as we move through this presentation. We also have some benefits that we've never covered before in any Washington National policy. Those can include Alzheimer's and complications due to diabetes. Now, we do have wellness benefits that are built into this policy, so we can even provide benefits when the client is healthy. But this policy in aggregate does not coordinate with anything else that you're likely to sell a client. no Medicare supplements, doesn't coordinate with any other medical plan. In fact, it doesn't even coordinate with other Washington national plans. So the client can own a standalone accident or standalone cancer plan and an active care policy, and if they file claims, both benefits will pay. In addition, this policy solves some problems that even exist in our portfolio. For example, I've got a great, very competitive hospital assure policy. It's a wonderful hospital indemnity plan. Once again, I'll put it up against anybody's hospital indemnity plan out there. Ask me about it. I'd be happy to share it with you. But that policy does have limitation. I can sell it to age 69 in most states. With this policy, I can sell hospital indemnity benefits to an 85-year-old. In addition, my accident plan has the same disadvantage. I can sell it to a 69-year-old, and that is for the base plan. That's the maximum age limitation for issuing. Here, I can offer accident benefits to an 85-year-old. And guys, you're not going to see this on the slide, but feel free to jot this down. We can offer heart attack stroke benefits, even up to $100,000 to someone who has full-blown diabetes. Let me repeat that. We can sell heart attack stroke benefits to someone who has insulin-dependent diabetes. There isn't another carrier in the marketplace that I'm aware of that will provide heart attack stroke benefits to a person on insulin or any kind of diabetic. And we can do that with this policy. We simply don't ask the questions. That is another differentiating benefit within this policy. So those are the first two modules or the first two elements of the policy. Now let's go ahead, take a deep breath, and jump into the features and benefits of the policy. Now, as I mentioned, this is a modularized plan design. There are 5 modules: cancer with recurrence, heart attack, stroke with recurrence, critical illness, and those 3 are lump sum benefits. The 4th module is a hospital indemnity, and the 5th module is an accident plan. And we're going to tear down each module, and we're going to look at the benefits that are contained within each module. In addition, the first 3 modules are lump sum modules, and within these modules, we've got lump sum benefits, partial benefits, and indemnity benefits built into the module. So let me describe each one of those. So our cancer with recurrence module, the lump sum benefit, the core benefit of the module is a lump sum benefit for the diagnosis of cancer, internal cancer. We'll pay between $5,000 and $100,000. That benefit is selected at point of sale. And it's payable upon the first diagnosis of cancer after the effective date of the policy. Now, I'm fairly careful when I'm talking about that. Why is that? It's because this benefit is available to cancer survivors. As long as they've been treatment-free for 5 years, they can buy this policy and receive their full benefit. Now, this policy also has partial benefits and indemnity benefits built into the policy. Our first partial benefit is a carcinoma in situ benefit. This is a Latin term for a stationary tumor, typically fairly easy to detect and treat. And for that reason, we're going to pay 25% of the lump sum benefit for a carcinoma in situ, with 75% left over for a secondary cancer diagnosis. Our first indemnity benefit of this module is a skin cancer benefit. It is a one-time benefit of $300 paid for any skin cancer. Can be basal cell carcinoma or even melanoma if it is still a skin cancer. Now, here's a unique benefit. It is the annual care benefit. And what I want you thinking here is a wellness benefit after diagnosis. So once you've been diagnosed, your annual care benefit is automatically going to kick in, and without filing claims, will provide you a $75 benefit each and every year on the anniversary of your lump sum benefit payment to offset your annual care expenses. These are for your tests to ensure that you are still not at risk for your cancer. These are your follow-up visits with your oncologist to ensure that you don't have cancer. Every year for 5 years, you're automatically going to receive that $75 payment. Now, should your cancer put you in the hospital, we do have a benefit here as well. And this is an example of an indemnity benefit along with the annual care. Should your cancer put you in the hospital, we will pay $300 per day. We will pay for 3 days. will pay that 3 times a year, or a lifetime benefit maximum of $15,000. Now, this hospital stay and these indemnity benefits are paid on top of the lump sum benefit and available to every covered member of the family. Now, I know I went through the hospital stay fairly quickly. I'm actually going to repeat that 4 more times as we work through this policy. Now, an add-on to our module, or like a buy-up feature for our cancer with recurrence module, is our radiation and chemotherapy rider. This is an indemnified benefit rider, meaning every time your client files a claim, they're going to receive a benefit. And we pay 3 different ways on this rider. The first is radiation. Should you receive radiation, we'll provide a benefit of $200 per day, offset for up to $5,000 per year, rolls over to 0 every January, no lifetime maximum. Injected chemotherapy is another way. It works just like the radiation. We'll pay $200 per treatment, up to $5,000 per year, rolls over to 0 every year, no lifetime maximum. Oral chemotherapy pays $300 per month and will pay for 36 months. Does not have to be consecutive. So all of these benefits are intended for the client to use. Maybe they're cured of their cancer, or they go into remission. Maybe that cancer comes back and they need access to these benefits again. They're always going to be there for the client. So radiation and chemotherapy upgrade. And that wraps up all of the benefits in our first module. So let's now jump into our second module, and that is the heart attack stroke with recurrence module. Much like the cancer module, it features a lump sum benefit that ranges between $5,000 and $100,000 for the first diagnosis of heart attack or stroke after the effective date of the policy. Once again, we only look back 5 years for any kind of heart attack or stroke incidents, and therefore, if they've been 5 years treatment-free, they have full access to this policy. Like our cancer plan, we also have partial benefits and indemnified benefits, so let's run through those. The first of our partial benefits is a coronary bypass benefit. Should I need a coronary bypass, we'll pay 50% of the lump sum coverage directly to the insured, with 50% left over for a secondary diagnosis. Angioplasty stents, or TIAs, sometimes known as mini strokes, all pay at 25%, once again with 75% left over for that secondary heart attack or stroke diagnosis. Should your heart attack or stroke put you in the hospital, like our cancer plan, we'll pay $300 per day. We'll pay that for 3 days. We'll pay 3 times a year, or a $15,000 lifetime hospitalization benefit tied to heart attack and stroke. So therefore, for those that are keeping score, if you add up just the hospitalization stay availability within our cancer and heart stroke policies, you have $30,000 of available heart attack or available hospitalization benefit that is available to each client, that pays on top of the lump sum benefit and is available to each covered member of the family. I'm hoping by now, just early on, you're starting to get a sense of just how robust and how benefit-rich this plan design is. Like our cancer plan, our annual care benefit works exactly the same way. After you've been diagnosed with a heart attack or stroke, we will provide a $75 automated benefit on the anniversary of your lump sum payout, so that you can take that benefit to your doctor, get your wellness checkups, and help relieve some of your out-of-pocket costs to ensure that you are still not at risk for heart attack or stroke. Now, as I mentioned, in both of these modules, they have a recurrence benefit. So the recurrence benefit on these modules work exactly the same way, and it's this way. Take a look at the chart at the bottom of the slide. You need to go at least a year from your initial lump sum payment to start building any recurrence benefits. And as you can see, it increases by 10% every year up to year 5, where you get 50% of your lump sum benefit in a recurrence benefit. So let me give you an example here. Let's say that somebody had a cancer and they had a $30,000 benefit. They received their $30,000 for their internal cancer diagnosis, and then 5 years later they were diagnosed with another cancer, or it can even be a recurrence of the same cancer. Doesn't matter. As long as we've got a pathology report that says that they've got cancer again, we're going to pay another $15,000. So that client is receiving $45,000 on a $30,000 benefit, because this is a built-in benefit. It is not a rider. Now let's jump into our third module, and this is our third lump sum benefit. And this does not have a recurrence benefit. It is a standalone. So therefore, consider this a rider. So let's take a quick break here. We've got two modules that we discussed, a cancer module and a heart stroke module. You got to sell one of those two modules. Now, you can certainly sell both, but you got to sell one or the other to have access to your critical conditions, your hospital indemnity, and your accident modules. Consider the next three modules as riders. So the critical conditions rider will pay a lump sum benefit for a major organ transplant of 100%, or even if you go on the major organ list, we'll pay 50% of your lump sum benefit once you go on that list, and we'll pay the other 50% once you receive your transplant. Paralysis and coma both pay at 100%. Blindness is paid at 100%. Now, I also mentioned before at the top of the presentation that we have a kind of a unique benefit tied to diabetes. I also mentioned that we wouldn't ask any questions about diabetes with heart stroke, but we do ask questions about diabetes with our critical conditions benefit because we've got a benefit specifically tied to diabetes. Now, what I was for here when we were designing this policy is I wanted just a $25 diabetes benefit, something that we just recognized the illness. And our actuaries said even that would destabilize the pricing structure in the policy. But to their credit, they came back and they said, hey, look, if we have to take somebody's foot because of diabetes, we're going to pay 50% of their lump sum benefit directly to the insured with 50% left over for another critical conditions diagnosis. Not bad horse trading. Now, we also have another unique benefit, and that is an Alzheimer's benefit. Now, they got to be diagnosed with Alzheimer's. Just dementia doesn't work. But if they've got an Alzheimer's diagnosis, we'll pay 50% of their lump sum benefit for that diagnosis, with 50% left over for another critical conditions diagnosis. Deafness will pay 25%, with 75% left over for that secondary diagnosis. End-stage renal failure, sometimes known as kidney failure, also 25%. And should your critical condition put you in the hospital, we would, like our other modules, pay $300 per day for 3 days, 3 times a year, or a $15,000 lifetime maximums. Once again, for those that are keeping score, we're now up to $45,000 of available hospitalization benefit that is paid on top of the lump sum benefit and available to each covered member of the family. And keep in mind, these benefits are designed not to pay the doctors and the hospitals, but to go directly to the insured. They can use this money any way that they see fit, and it can use to help offset their own out-of-pocket expenses. They're not designed to pay for cancer, heart attack, stroke, or a critical condition, but they are designed to help offset the client's own out-of-pocket costs, and they do a very, very good job of that. So now we've wrapped up the 3 modules for our lump sum benefits: cancer with recurrence, heart attack, stroke with recurrence, and our critical conditions rider. Now let's jump into the 2 indemnified benefit modules, and the first is our hospital indemnity benefit. So this benefit is paid for any client that is admitted to the hospital for any reason. It doesn't have to be cancer, heart attack, stroke, or critical conditions. It can be because they fell off a ladder, or were hit by a car, or they have asthma, or they had COVID. For any reason that they're admitted to the hospital, this benefit would pay. Now, there are 2 triggers. I mentioned one of them already. They got to be admitted. The second trigger is they got to be there for 24 hours. If they're admitted there for 24 hours, this policy is going to pay $200 per day for that hospital room, and jumps up to $400 per day if they're in ICU or subacute ICU. And like our other modules, we'll pay for 3 days. We'll pay 3 times a year, or a lifetime maximum of $15,000. Once again, now, for those keeping score, we're up to $60,000 of built-in available hospitalization benefit that pays on top of any of the lump sum benefits and is available to each covered member of the family. Now, pregnancy is a covered benefit under this policy. However, they need to own the policy for 2 years before they can file a claim for pregnancy. We also have $200 for $75 for wellness benefits, doctor's office visits. We pay $200 for outpatient surgeries. We provide benefits for hospital stays, ICU stays, as well as short-term medical, all packaged within this hospital indemnity benefit. Now, the last module is, and our fifth module, is an indemnified accident rider. Now, here this rider it's broken into two segments. The first is an accidental death and dismemberment benefit, which provides $50,000 for a common carrier, vehicular, or any kind of pedestrian accidental death. It also pays the same amount to the primary insured, the spouse, or the children. $50,000 benefit that is can be packaged or stacked on top of another accidental death and dismemberment benefit from our standalone accident policy, for example. Now, we also have benefits that include fractures, dislocations, burns, injuries requiring surgery, paralysis, and so forth. So let's move through some of those. Our fracture benefit has a range of $200 up to $1,200, depending upon the fracture. We don't really care if it's a partial fracture, hairline, or full break. Doesn't really matter. We pay the same for each. For example, we've got if you break your hip or a thigh, we pay $1,200. If you break your forearm, it's $600, shoulder, $500. And the benefit's the same for any covered member of that family. If you have a dislocation, it is a range from $200 up to $1,000. For example, if you dislocate your hip, it's $1,000. If you dislocate your wrist, it's $300. Doesn't matter if it's surgical or non-surgical. It requires this. It's going to pay the same benefit. But let's go back up to the top because I want to point out one thing that's very important. Here you have a limitation on the number of days that you need to be treated in order for the benefit to pay. And I've tested this benefit before, guys, and Washington National Claims will not negotiate on this. If you have a dislocation, it needs to be treated within 90 days or they're not going to pay. And frankly, guys, I support this. If you've got a dislocated hip, don't wait 90 days to get it treated. Get it treated right away, and therefore we're going to pay. But there are some times where the doctor will advise the client, hey, let's just wait and see if it fixes itself. Don't. Get this treated within 90 days. Joint replacement. We will provide a $5,000 for a hip, knee, or shoulder joint replacement. But keep in mind here, and please note, this is for a covered accident. If your knee has worn out over time because of arthritis, this benefit is not going to cover that. It's going to cover if you have an accident where we have to replace the knee, that's going to pay $5,000. Here's another benefit that requires a limitation. If you have a surgery or a laceration rather, which requires sutures, get that within 72 hours. If so, we'll pay $100. If you wait longer, they're probably not going to be able to put sutures in to begin with, and they're also going to deny that claim. Injuries requiring surgery, really focused here on hernia, torn cartilage, or ruptured discs. We'll pay between $100 and $300. Now, one of the things that you might notice as you look through the materials for this policy, which I've sent to Lynn and John, is that we will actually increase the benefit, sometimes doubling or even tripling the benefit in the second year of owning the policy, because what we're seeing is people were buying this accidental injury benefit, getting their hernia fixed, and then terminating the policy. So we'll actually triple the $300 hernia benefit if they hold the policy for at least the second year. Burns, if they're second or third degree burns and treated within 72 hours, we'll pay $500. Now, if you go to an emergency room or urgent care, we'll pay $250 per accident per family member. So don't worry whether it's an urgent care or an emergency room. It all pays the same kind of benefit. Now, should your injury require additional doctor's office visits after the initial treatment, we'll pay doctor's office visits at $30 per visit, visits per accident per covered person on this policy. And as I mentioned before, none of these benefits coordinate with any other Washington national policies. And there are 54 indemnified benefits that are specifically pointed out in this accidental injury rider. So all told, we've got 75 lump sum and indemnity benefits built into this plan design. So then let's take a look at a couple of riders that I think add extraordinary value to these policies. And the first is our cash value rider. The second is our return of premium rider. Both riders have the same structure or intention, and that is to return unused premium to our clients. The mechanics are just a little different. And because of both of these riders are available on our active care policy as an option, same rate, just two different methodologies, I'm going to run through both, but I'm going to kind of suggestively sell the cash value rider. And here's the reason. I think the mechanics are a little better for the client. So let's talk about how these policies are constructed. First, for the cash value rider, you need to own the policy for 5 years. If you terminate the policy anytime within the first 5 years, you're going to get no premium back. However, if you terminate the policy in at least the 6th year, you're going to get about 5% of your premium back. And that premium stair steps or grows in value, cash value, up to year 25. And at year 25, you get all of your premium back, less claims incurred. So if you've had a series of small claims over the years, maybe some wellness claims, maybe an accident or two, but it did not eclipse the premium you put into that policy over that 25 years, you get that premium back. If you filed no claims, you get it all back. If you filed a few claims, you get the remainder back. Now, if you've had a major diagnosis, and benefit payout that eclipsed the premium that you put into the policy, well, you're not going to get any cash value dollars back, but aren't you happy that you had the policy because your benefits exceeded your premium? And that's really what this policy does for you. You have the benefits if you get sick. You have the cash value rider or the return of premium rider if you don't. With the advantage of including one of these two riders, you create an environment where your client cannot lose. The worst thing that happens is they break even. Now, this is a for-cost rider, and guys, because of the interest rate environment, it can be expensive, and it's not for everybody. In addition, depending upon the state that you live in, there could be age limitations where we can no longer offer this rider. In Texas, for example, it's 49 years old. Anybody over 49, don't even talk about a cash value rider. In Florida, for example, anybody over 49 as well. Don't talk about the cash value rider. But if you're in Oklahoma or Minnesota, you can sell this rider up to age 70. So once again, depending upon your state that you're selling, refer to your agent guide or ask anybody on my team what rider is available and what are the age limitations. Now the second rider is similar in the sense that it returns unused premium to the client, and this is the return of premium rider. Now this rider says that once you have the return of premium rider, you got to go the full 20 years. If you go you're 18 and terminate the policy or even pass away, you get no return of premium dollars back. So it's a shorter period. It's 20 years versus 25, but I think the mechanics are better for the consumer in that they can get their premium back or a percentage of the premium back beginning in the 6th year. Now, if you begin your return of premium period at 55 or younger, you got to go 20 years. Then you get your premium back automatically. You don't need to remember even that you have the policy. Washington National is returning the premium directly to the insured through the agent if the agent is still active. Now, if you begin your return of premium period between the ages of 56 to 65, you're going to get your premium back when you turn 75. And if you begin your return of premium period at 66 or older, you're going to get back your premium every 10 years. So that's how return of premium and cash value work. Both are for cost riders. Both have age limitations, so be aware of that, and both can add fairly significant premium to your client. So please be aware of that. However, it also creates an environment that no other carrier that I'm aware of can create in a supplemental health policy, and that is that you cannot lose. So I thought at this point, after having kind of run through an awful lot of material, let's take a step back and take a look at, okay, let's see what a plan design might look like and what might that claim look like. Here I put together a cancer policy. I put together put in the radiation and chemotherapy upgrade. I included the hospital and critical conditions rider, and I made this a $20,000 family lump sum benefit. Here I had a diagnosis that required radiation and surgery. So my benefit was $20,000 for my internal cancer diagnosis. But on top of that, I had 11 radiation treatments. This is an indemnity benefit that's built into the policy because I had that upgrade. That paid $2,200. Then I had a surgery with a 2-day hospitalization. Now, that member, because I had the hospital benefit, this hospitalization actually pays two ways. It pays $300 per day that I'm in the hospital because of the cancer hospitalization benefit. And then it also paid $200 per day that I was in the hospital for the hospital indemnity benefit. Therefore, I got $1,000 for my 2-day hospitalization. Now, my total benefit, therefore, for this claim was $23,200. Now, that's pretty cool, but here's what I think is really cool. The remaining benefits for the client are a recurrence benefit for the lump sum benefit under the cancer policy. They have the full $20,000 benefit available for any kind of critical conditions diagnosis. They have the full benefit available for their hospitalization, and they have all of the benefits in the policy available for their family members. We've already paid $23,000 under this benefit, and there is a ton of benefit left over for the client should they have another diagnosis or another issue that requires treatment. Let's take another look at a second example. Here I have a heart stroke policy, and I added in critical conditions, hospital indemnity, and accident. So the only thing really I'm missing here is cancer. I also included the cash value rider just for kicks. Here I had a $20,000 family plan and had a wellness checkup that detected blockage that required immediate surgery. So we're going to pay $75 for that wellness checkup, but we're also going to pay a $10,000 for that coronary bypass. Remember, that was 50% of my lump sum benefit, which was $20,000, so I get $10,000 for that coronary bypass. Now, here I had a hospital stay of 4 days. Now, you remember, we only paid 3 days per hospital stay, so one of those days is not going to be paid. However, we are going to pay for 3 days at $900 under the benefit under heart stroke, and we're going to pay $600 for the benefit under the hospital indemnity plan. Therefore, we're paying $1,500 for a 3-day stay. Therefore, my total benefit under this individual claim was $11,575. Now, I didn't have a heart attack. We just had an event that required some surgery. So therefore, I still have the $10,000 available under the heart stroke policy. I still have the $20,000 available under the critical conditions plan. I still have the full hospital indemnity benefits available to me should I ever need a hospital stay again. And I have a full accident benefits available under this policy. And all of these benefits, everything is still available to all covered family members. So now I'm hoping that you really get to see just how flexible this plan design is and just how benefit rich it is for the client. I don't think it can be touched by another policy in the industry. Now let's jump into another module of the under the features and benefits, and let's take a look at some rate examples of the policy. Now, these aren't the rates for the policy. These are just examples that I kind of selected based upon the face amount and the age of the client. And here I took a look at what are the rates going to be if I include cash value onto this policy. Now, cash value, when I include it on the policy, is always going to be more advantageous for the client should the client want the policy, always going to be better in the younger ages. So here, a nice example might be a $5,000 benefit for a 44-year-old cancer-only plan design. Family benefit with cash value is $22.80 per month. Not bad. A $10,000 benefit, same age band. Here I included cancer, heart stroke, and critical illness with cash value. Family plan, it's a little more expensive. It's $112 per month. The last one might be an example of a $20,000 benefit, 49-year-old, heart stroke only policy with cash value, single parent. So it's myself and all of my kids. That's $45 per month. Not bad. Now let's take a look at some examples of this policy without cash value. So it's the base plan only. Let's say that they either were too old to be offered the cash value rider, or it was just cost prohibitive for what they wanted to build into the policy. My favorite rate is actually the second one down, and that is the the third one down. That's a $10,000 benefit, 49-year-old combo plan. This is going to be my cancer with heart, with critical illness, with radiation, with critical conditions, with hospital indemnity, and with accident. That's a fully loaded plan design at $10,000. That's $137.10 per month. So where does a plan like that fit in the pantheon of medical benefits that your client may own? Well, consider this positioning. You've got a client that and all of your clients are going to have the same complaint, and that is, you know what, my medical expenses, the cost for my medical plan, be it Medicare Advantage, Medicare Supplement, high deductible major medical plan, healthcare plans, they all have the same complaint, and that is, I'm having trouble controlling my medical costs. My rates keep going up, having trouble controlling that. Here's what you can do. You can advise your client to talk to their medical plan provider, their agent or the provider itself, and increase the deductible and the copays of that plan design. Those are the levers that can be shifted within the medical environment. The higher the deductible, the cheaper the monthly premium. Therefore, the inverse is also available. The lower the deductible, the higher the monthly premium. So therefore, by shifting that lever, increasing the deductible, you're reducing the monthly premium for that medical plan. And what you're going to tell them is you're going to gap fill with their active care policy at a $10,000 family benefit. So if in this scenario you're saving $200 per month by moving your client to a higher deductible, and then we're inserting the active care plan as a gap filling solution for all of their catastrophic needs, cancer, heart attack, stroke, critical illnesses, hospitalizations, and accidents at $137.10 per month. Well, now we're creating an environment where your client is actually saving money on their monthly expenses. We've saved money on their their medical plan. We're gap filling with our cancer policy, and we're going to save them roughly $60 a month in that transaction. This is exactly how we're selling this policy at the work site or to an individual or to a senior. Doesn't matter. Same rate, same structure, same proposal. Now let's even take a look at the senior market, and let's even specifically look at Florida, because I know that you guys do a lot of business in Florida. My favorite plan is actually the first one. It's a $5,000 benefit, turning 65, combo plan. That's the cancer with heart attack, stroke, with critical illness, with the accident benefit at $35.30 per month. So if you consider sticking this on top of a Medicare supplement policy or Medicare Advantage policy, you're gap filling at $5,000 a month. They probably don't even need more than $10,000 because their Medicare Advantage or Medicare supplement policy is typically provides pretty good coverage for a senior. Now, also keep in mind that if you're selling a Medicare Advantage policy, there could be additional out-of-pocket expenses, especially for catastrophic illnesses. So please be mindful of that. And certainly offer this policy as a gap-filling solution to those seniors. But it dovetails very well with the Medicare supplement policies, and we sell a ton of active care policies in the senior market. In addition, if you just go all the way to the bottom, a 69-year-old, $5,000, everything we have in the policy is still only $88.60 per month in Florida. So this is an affordable option to ensure that your seniors have access to their the money that they've saved, that nest egg that they've spent their entire life building. See, because the one thing that seniors aren't necessarily afraid of, at least the ones that I've talked to, is getting sick. They recognize that at some point in their life they're going to get sick and they're going to need medical attention. What they're really afraid of is running out of money. So if you could provide them a solution that pays cash dollars directly to them that they can put back into their nest egg for any money that comes out of it for hospitalization or medical treatment costs, they're going to be thrilled with that, and that is how we position this policy in the senior market. So let's take a look at underwriting. So let's move into the another module of this policy, another element of this policy, and talk about underwriting. Now, underwriting is based upon the modules that you sell. So if you sell everything loaded up in this policy, we're asking 20 yes or no health questions. Remember, we only look back 5 years. There's no MIBs, no PHIs, no medical tests, no questions for accident, radiation, and chemotherapy. So you're going to have a pretty good idea at point of sale if this policy is going to get issued or not. Now, the questions that we ask are predicated on the modules that you sell. We got 3 questions we're going to ask everybody. If you're selling the cancer module, you're going to ask 4 questions. If you're selling the heart module, we're going to ask 4. If you're selling critical conditions, we'll ask 3. And if you're selling the hospital indemnity rider, we're going to ask 6. So if you want to eliminate some health questions right off the bat, don't sell the hospital indemnity benefit. But if you're selling the hospital indemnity benefit, you got to ask that and the other 12 questions. So let's break down each one of these questions. The first 3 questions include a replacement question. Are you using tobacco, and have you used tobacco in any form in the last 10 years? And do you have AIDS, HIV, or ARC? The first 2 questions are not eligibility questions. The last one is. If they have a diagnosis of AIDS, HIV, or ARC in the last 10 years, ball up the application, throw it away, and ask for a referral. There's nothing we can do for this unfortunate client. It is a knockout question. However, and this happened 4 times last year, if they have had a diagnosis outside of the last 10 years and have been treatment-free, the AIDS or HIV has actually gone into remission, we can sell the policy. So make sure you ask that question specifically. Now, if you're selling the cancer module, you're going to ask these questions only when selling the cancer module. Have you had any of the 12 cancer conditions listed on the application diagnosed or treated in the last 5 years? If yes, skip the cancer and go right to heart stroke, because that's a knockout question. But if they say no, let's keep going. Have you had a 5-year look back for a pre-leukemic or a pre-malignant condition? Your client's going to know if they've got one. In the past 12 months, have you been advised to have surgery, treatment, or incomplete tests, or any diagnostic tests tied to the cancerous conditions or a pre-malignant condition? The first 2 questions. If yes, can't sell the policy. If no, let's keep going. In the last 12 months, if you had any abnormal tests that have not been negated by a positive test tied to any cancer conditions, pre-leukemic or pre-leukemic conditions. What we're trying to catch here is somebody that had, a bad pap smear, or their numbers are not good on their checkup, or they've had a test and they suspect, oh boy, I think I've got cancer. I better run out and buy a cancer plan. We want to cover healthy people, but we don't want people that specifically are buying this policy just as a backstop because they haven't had their diagnosis complete yet. So that's why we are asking those 2 questions. And those are the cancer questions. Your heart stroke questions, similarly, are a 5-year look back for 16 heart stroke related conditions that are listed on the app, and a 6-month look back on a blood pressure reading of 150/95. Now, let's say that your client says, yeah, I remember my reading, but I don't remember when I had it. What's your answer? Well, your answer is no, because your client is answering the question to the best of their ability. Let's say they had a reading 2 weeks ago, but they can't remember what it was. That's fine too. Answer no. If they have actually a heart attack within the first 2 years, we're going to be talking to their doctor anyways. Go ahead, answer no here, and let's keep going. Now, these two questions are going to look familiar. They're the exact same questions that we asked under cancer. In the last 12 months, have you been advised to have surgery, treatment, or incomplete tests or diagnostic tests tied to heart attacks, strokes? The first two questions. And same thing, same question for the last question. Past 12 months, have you had an abnormal test that has not been negated by a positive test for heart attack or stroke? No to everything, you're going to get your policy issued. Yes to any of those questions. Don't sell heart stroke. Let's go to cancer and move on. Now, as I mentioned before, you got to sell a heart stroke or a cancer module in order to have access to the critical conditions, hospitalization, and accident benefits. Now, there is a limitation here, and that is that we will complete an RX check for anybody over the age of 60, or 65 rather, with a benefit amount that is over $60,000. So if you want to avoid an RX check for any of your clients, sell under 65 or sell under $60,000. If they are over the age of 65, just know that once you submit that application, we're immediately going to do an RX check. So make sure that they're not taking medication, which would decline them otherwise. And I've already sent the declinable medications list to John and Lynn. If you're selling a critical conditions rider, this is our third lump sum rider and our third benefit. We only look back 5 years for any critical conditions that are listed on the application, and then we have our two 12-month questions. Have you had surgery or a diagnostic test tied to your critical condition, or have you had an abnormal test that has not been negated by a positive test for the critical condition? No to any of that, keep going. Your 6 questions for hospital indemnity include, are you currently confined to a hospital? Guys, please don't have somebody sign up for this benefit while they're currently confined. Just please. Now, well, the next question is a 5-year look back for 24 conditions listed on the app, a 2-year look back for 10 conditions or surgeries that are less serious that are listed on the application. Are you currently pregnant? And that is going to be a knockout, and we'll address that here in just a moment. And then the 2 diagnostic questions or test questions that we've covered in the last modules as well. So all in all, there are 6 yes or no knockout questions for hospital indemnity. So if you want to limit your underwriting, the first thing that I do is I take off hospital indemnity. The second thing is if your client is rate sensitive, the first module I take off is this, because this is the most expensive of any of the modules. Now, let's position this policy in the marketplace. That's all of the underwriting. Everything, every question, yes or no health questions, pretty simple. If your client says yes, either skip that module, or if they say yes to a cancer question and yes to a heart stroke question, you can't sell them anything and just get a referral. If that doesn't make sense, I'll address it again in the question and answer segment. But we are rounding the curve here, and I think I'm still pretty good on time. So where do we position this policy? Well, when I was talking about rates, I think we did some positioning there. This policy is designed as a gap-filling strategy for major medical, high deductible major medical, Medicare Advantage, or Medicare Supplement policyholders, because there are fixed responsibilities or fixed costs in all of these plan designs that affect the rate. So repeating your major medical policy or your Medicare Supplement policy, their rate is designed around the copays and deductibles. The lower the copay and deductible, the higher the monthly premium is for that policy. a simple way to create some income for your clients that can be spent on supplemental health plans is to increase the deductible or copay for any of those policies, gap fill with our supplemental health plan design, active care plan design, and ultimately the goal is to save your client money while providing that backstop for their out-of-pocket costs. Now, it can go even further than copays and deductibles because this policy, because it's paid directly to the insured, can help offset out-of-pocket network, out-of-network treatment charges because isn't it in your client's best interest that if the best guy out there to treat cancer is not within your network, by gosh, go get treated. Get the best doctors, best hospitals you possibly can, even if it means travel, because you've got the backstop of our active care policy. And for those that are seniors and that have a prescription drug plan, they've got that big donut hole. And because these benefits pay directly to the insured for cancer, heart attack, stroke, they might be taking prescriptions tied to that, but by gosh, they're getting a lump sum benefit paid directly to them. Those dollars can be used to offset those donut hole costs or at-home recovery costs or durable equipment costs not covered by their major medical policy. And once again, our benefits do not coordinate with anything else that they may have. In addition, the last benefit here, the indemnity medical prospects. One of the things that we've seen recently, and I'd say recently within the past 8 to 10 years, is the rise of the high deductible major medical plan and the increase in the usage of the indemnity medical plan. Now, for those that are old like me, we remember the days of the indemnity medical plan. These are the medical plans that predated the PPO or the HMO plans that we have today. The indemnity medical plans were relatively inexpensive, and they were really designed as treatment policies for non-catastrophic injuries or illnesses. Doctor's office visits, colds, flus, broken arms, limited benefit, but there's nothing in these policies for a catastrophic illness or catastrophic injury. So we've seen a lot of the marketplace gravitate to these indemnity medical plans. Hey, great for them. They've lowered their monthly cost for their medical policy, but what they've done for themselves is they've created a gigantic risk for any kind of catastrophic injury or illness. So seek those people out and ensure that they are protecting themselves and their income and their savings by gap filling with an active care policy. Now, the life clients are a prospect as well because there's a lot of policies out there, life insurance policies, that have some living benefits tied to them. So if they have a diagnosis of cancer or another critical illness, they can pull benefits from their life insurance proceeds to use as living benefits for their policy. And, you know, that is not a terrible solution for clients that don't have access to any other living benefit out there. But they do with this. So what I'm going to say is, you know what? Leave those life insurance policies alone. Even if you have a built-in living benefit for your life insurance policy, don't use it. Use the living benefits that are found in the active care policy. Now, why do I say something kind of radical like that? Well, your life insurance policy was not purchased to ensure that you've got access to living benefits. It was purchased to protect your family if you should die too soon or die before they're ready for you to pass on. And that means that you're providing these life benefits directly to your beneficiaries so they can manage the household should you pass. That's what life insurance is for. It's not really designed as a living benefit. So I say, let the life insurance policy do what it is supposed to do and provide that protection for your family if you should die too soon. Let the active care policy pay those living benefits and leave that life insurance policy alone. I would even say that disability benefits or clients with disability is a wonderful prospect for an active care policy, and here's why I say that. If you're disabled because of a cancer, heart attack, stroke, accident, or an illness that puts you in the hospital, and you have a disability policy, that's fantastic. Great. But keep in mind, that disability policy, even at a maximum benefit of 66%, means that your client is going to have to operate their household on a third less income than they did when they were healthy. So it's good that they've got the disability benefit. It's something, but it's not everything. And when you introduce a gap-filling solution like Active Care into a disability client, now they're getting a little closer to that full income, aren't they? Because these lump sum benefits are paid directly to the insured to help offset those benefits not covered by disability. And by the way, those costs that are not covered by disability, those are taxes. So let's round the corner here and talk about a couple sales tips. And I already talked about my favorite one. It's the one at the bottom. It's the cash value return of premium rider. And then it says this sales tip is this closing technique is simply this. Hey, look, if you get sick or injured, you have the policy. But if you don't, you get your money back. How do you feel about that? Well, you know, any positive response to that question, that open-ended question, is going to result in a sale. Fantastic. Let's talk about the plan design, sign here. The follow-up question for that is, hey, does your homeowners, car insurance, or any other, your medical plan, your Medicare supplement plan, does it return your money if you don't use the policy? There's no other policy like that that is going to return it. The best question is best question asked is one you already know the answer to. And up top, I always love this too. Hey, did you know that 61% of all cancer treatment costs are non-medical in nature and therefore not paid for by your major medical, Medicare Advantage, or Medicare supplement policy? How do you feel about that? And the follow-up question would be, would it be easier to budget for a full supplemental health policy or budget for the unplanned medical costs of cancer, heart attack, stroke, or a critical illness? Obviously, the easier and the better solution is to budget for the supplemental health policy. And that's a wonderful open-ended closing question that I've used fairly frequently. Probably the biggest thing that I've seen in the supplemental marketplace is, hey, get referrals. If we're selling to a senior, get referrals to the family members and vice versa. But also, because this policy can be sold in a worksite environment as well as a direct sale, hey, don't worry about getting referrals to a business as well. We can show you how to sell in the worksite market. This policy or any other policy, very simple. It's just an added step. Or sell to other folks in that direct marketplace. So, in review, this active care policy covers 17 types of critical illnesses, 14 different types of accidental injuries, benefits that range from $5,000 up to $100,000 in coverage. It features simplified issue underwriting, which we covered. You're going to know at point of sale if that policy is going to get issued or not. We turn these policies around very quickly. So if you write send in business on a Wednesday, we're issuing that policy on Thursday. We're paying commissions on Friday. We turn that around very, very quickly. We also turn around claims fairly quickly. Our average claims payment is 8 calendar days. It can certainly be a lot more than that. And it can be less, too, depending upon the type of claim that they're filing or how they're filing the claim. So we'll cover that at another meeting as well. And lastly, the cash value return of premium rider creates that unique environment where your client cannot lose if they have that rider. That really provides some steel plating around your policy. Somebody from our good friends at Aflac or Colonial or GTL, they're not going to be able to come into your clients and say, oh, I've got a better critical illness policy than that. Does it return my premium if I don't use the policy or if my claim doesn't exceed my premium? They're going to have to say no. because they don't have the return of premium rider. Therefore, they're going to turn your client away or turn that agent away without even having to call you. It protects the policy from our other competitors as well, fine as they may be. So before I open up the lines to questions, and I hope there are some, feel free to ask them. I wanted to talk about the bonus program that we've created specifically for our friends here at Golden Care. So between June 1st and August 31st, so if you are not already signed up with Golden Care, please visit with Irina and Lynn and get signed up with Washington National. We can turn around a brand new agent number in a day or two and get you trained, one-on-one training on how to access BizLink, which is our business management portal, and how to take an active care application. We can do that whenever you need us to, so just let us know. Now, if you write $10,000 of issued premium, we're going to send a bonus check to you of $300. If you hit $20,000, we're going to send you $600. If you hit $30,000 issued between now and August 31st, we're going to pay $900. And for the first 3 Golden Care agents to hit $30,000, we're going to add a $500 bumper bonus. So we're going to pay $1,400 bonus on top of your commission for that $30,000 of issued premium. Rules. It only issued premium counts, so it's got to be issued by the 31st. All Washington National products count, so it's not just Active Care. If you plan to sell any of the other Washington National products, this counts toward this bonus program as well. We will pay the bonus to the agent's account within 2 weeks of the end of the period, or if you hit the maximum bonus amount before August 31st, we'll get it paid out directly to you. In addition, I will pay another bonus program, and we call that the George Bucks. I'll pay a $20, I'll write a thank you note and give a $20 gift card for the first issued Washington National application that any of you write. Now also, I'll provide a $100 bonus for that 5th issued application, and I'll spend another $100, I'll put that in your account, for that 10th application. So I'll pay $220 for your first 10 applications, and those 10 applications also count for this value add or this premium bonus program. So please take advantage of both of these programs. Allow us to put some, allow us to say thank you and put some bonus dollars in your pocket along with commission and providing the benefit that this unique active care policy can provide to your clients. Okay, with that, let's go ahead and John and Lynn, if you guys can open up the lines, I'll take any questions that anybody may have.
I can read off some of the questions.
Okay, let's do that.
When will sales material and rates be available to discuss?
I have already sent rates as well as brochures to Lynn. She has them available for distribution.
Sounds good. Does it, when you said it covers diabetes, is it type 1 or it'll insure diabetics, type 1 and type 2 diabetics?
So let me revisit that. So if somebody is a type 1 or type 2 diabetic and they want the heart stroke policy, if you guys will recall when I was going through the underwriting, I said there are no questions about diabetes. So they can get that kind of coverage. The only time I ask about diabetes is in the critical conditions, and that is type 1 or type 2. So if they've got diabetes, they can't get the critical conditions benefit or module, but they can get the heart stroke module. So we can provide them cancer, heart attack, stroke, hospital indemnity, and accident benefits.
Great, great. So, and I can't even think offhand, what is ARC?
ARC stands for AIDS-related complex.
Oh,
if your client
okay,
has a diagnosis, they know what it is.
Right. I would. Somebody asked that question, and it's like, wow, I don't remember what that is.
Yep, fair question. I get that a lot, actually.
Anybody else have any questions? You can either type it in. We got quite a few. Looks good. Sounds good. replies.
Friends, I want to thank you. Go ahead.
Yeah, somebody's asking, do you offer group rates for small businesses?
The rates for this policy are exactly the same as direct. So we can sell this to a small business or to somebody at the kitchen table. It's the same rate. And the advantage of doing that is that if you sell this to somebody at the small business and they leave the small business or retire, they can take the policy with them at the exact same rate. Just convert it from payroll deduction to an EF. Good question.
Is that a list bill?
Yep, we can do list bill, we can do payroll deduction, we can do what's called employee non-payroll, where we can sell it at the work site and still collect premium out of their checking account. We can do direct sales, which is monthly EFT or ACH, and we can also bill on a 6-month or 12-month billing cycle.
Good, that's very nice.
So I guess the bottom line is however you want to sell it, we can figure a way to get it done.
Okay. We just have a lot of great presentation. Thanks. Looks like a great product. So sounds great. Well, I want to thank you again, Mark. That was a great presentation. Gave us a good look at rates. It's very affordable and very flexible. So I think as we move on here, we're going to get some action out of there, and hopefully somebody on the call today gets an extra $1,400.
I'd love to pay that. My favorite thing to do is write thank you notes and to pay bonuses. So guys, I want to thank you for your time and your talent, and please take advantage of this team if you have any questions or concerns.
Thank you, everybody, for joining us today. I hope you enjoyed that. Feel free to give us a call at 800-842-7799 or shoot us an email at marketing@goldencareusa.com. And with the help of Mark and his Washington national team and with us here at Golden Care, we should be able to get all your answers and questions answered, I should say. Thanks much. Have a great day.